Hello, I'm John AG, and I want you to pause for a moment because the silver market is sending a signal that doesn't wait for headlines, doesn't ask for permission, and doesn't repeat itself for late arrivals. This isn't a warning about something that might happen weeks from now or a theory about some distant future event. This is about a shift that is unfolding in real time, quietly, while most people are distracted by noise. If you miss it, you won't miss it slowly. You'll miss it all at once, when price adjusts before explanations catch up. As I'm recording this, it's Sunday, February 1st. And the silver market is doing something that looks chaotic on the surface, but deliberate underneath. The mistake most people make is assuming volatility means uncertainty. Sometimes volatility is clarity trying to break through denial. The conversation circulating right now focuses on one uncomfortable detail. China has been absorbing silver at a pace that has pushed its domestic pricing above the rest of the world. That alone should make you stop and think. Markets don't pay premiums for fun. Premiums exist because someone wants the metal badly enough to outbid the alternative. The question that matters isn't whether China is buying. That part is already visible. The real question is why the buying looks persistent rather than opportunistic, and why the domestic price refuses to reconnect neatly with global paper pricing. When you see that kind of disconnect, you're not looking at speculation alone. You're looking at urgency. There's a familiar rumor that surfaces whenever currencies feel unstable, the idea that a nation might anchor its money to something tangible. I'm not here to sell you a fantasy or repeat a simplistic narrative. In fact, I'll challenge that idea directly later. But dismissing the signal entirely is just as dangerous as believing it blindly. When a country begins accumulating a strategic metal and its internal market starts behaving differently from the rest of the world, the correct response is not excitement or panic. It's analysis. You ask who is under pressure, who is preparing, and who understands that the next phase of the system may not reward passivity. To understand what's happening, we need to step through this carefully. First, we need to look at the price behavior itself and why recent swings don't automatically signal exhaustion, even though many commentators are eager to declare a peak. Then we need to translate what physical tightness actually means in simple terms, because the phrase gets thrown around without explanation. Finally, we need to connect those signals to currencies, trade systems, and incentives that most retail investors are never encouraged to think about. Near the end, I'll walk you through one specific scenario that could make the next move in silver feel abrupt and unfair. Not because the market is broken, but because expectations are. Let's start with what everyone has noticed. Silver has been volatile, sharp rallies followed by sudden pullbacks, then renewed strength. Each swing triggers the same cycle. Charts circulate, certainty follows, and someone confidently announces that the move is finished. Tops are declared loudly, usually after price has already moved. What matters is not how dramatic the move looks, but how the market responds when pressure appears. A true top isn't just volatility. It's the absence of buyers. It's when rallies fail and weakness accelerates because demand steps away. That's not what we've seen. Instead, dips have been met with interest faster than expected. That's not random behavior. That's structure. Markets driven by real-world demand behave differently from markets driven purely by leverage. You can still get violent moves in both, but the difference shows up in follow-through. When actual users and long-term holders need the material, they treat declines as access points, not exit signals. Over the past several weeks, silver hasn't collapsed under pressure. It has stabilized repeatedly. That tells you something about who is on the other side of the trade. Now consider the narratives that appear during these moments. There's always a clean explanation offered right when emotions spike. Index changes, fund adjustments, scheduled rollovers. These events are real, but they're rarely decisive on their own. The problem isn't that these explanations exist. It's how they're used. They're amplified, repeated, and framed as imminent threats to scare behavior in one direction. The event itself might be modest, but the story around it becomes overwhelming. When warnings feel urgent and universal, you should ask who benefits from that urgency. Fear campaigns are rarely designed to protect the average participant. Physical silver creates discomfort for systems built on abstraction. When someone buys a paper product, the metal stays inside the structure. It remains a claim, a liability, something that can be reused, lent, or leveraged. When someone takes physical delivery, the game changes. Metal has to be sourced, moved, stored, and accounted for. It stops generating fees and starts generating friction. Enough friction forces adjustment. That's why narratives intensify when physical demand rises. Volatility becomes the excuse. Control becomes the objective. This brings us back to China, and this is where context matters. Silver is not a stranger to Chinese monetary history. For centuries, it functioned as everyday money. That historical memory doesn't vanish just because modern systems evolve. Add to that the industrial reality. Silver remains essential for high-performance electronics, energy infrastructure, and precision applications where conductivity and reliability matter. Recent trade data and disclosures show that silver-bearing materials flowing into China have remained elevated even as other imports softened. That doesn't look like panic buying. It looks like planning. Premiums are the market's most honest signal. When domestic prices trade above external benchmarks, the message is simple. The metal is wanted here, now. Premiums attract supply, encourage arbitrage, and reveal mismatches between paper availability and physical necessity. In China's case, the premium hasn't been fleeting. It has reappeared consistently, signaling ongoing tightness. And tightness doesn't show up everywhere at once. It appears first in delivery windows, smaller formats, specific components, and localized shortages that don't make headlines. Silver occupies an unusual position. It is an industrial input with monetary characteristics. It doesn't need excitement to move. It needs persistence. Industrial demand alone doesn't create explosive price action. Stubborn demand does. When systems are built around a material and supply can't respond quickly, the adjustment mechanism becomes price. Add investment interest to that equation, and the response can accelerate because supply chains move slower than capital. Now let's address the idea that always follows. Does this mean a currency will be formally backed by silver? That's where discipline matters. Backing a currency with metal is not a symbolic gesture. It requires transparency, redemption mechanisms, and a willingness to surrender monetary flexibility. Most governments resist that because flexibility allows intervention, stimulus, and control. Metal backing imposes constraints, and constraints are politically expensive. So no, I'm not assuming a formal declaration or a dramatic announcement. But strategic use doesn't require convertibility. Stockpiling, encouraging domestic ownership, bilateral trade arrangements, and reserve diversification can all occur without fanfare. These actions still influence markets because they change flows. The more important question is not whether a currency will be backed, but whether a country is reducing reliance on systems it doesn't control. The dollar system is not just a currency, it's infrastructure, settlement, and leverage. Diversification away from that exposure doesn't happen overnight, but it does happen incrementally. Metals play a role because they are not someone else's promise. When you look at silver through that lens, the recent behavior makes more sense. This is not a cartoonish plot or a sudden revolution. It's gradual repositioning interacting with a market that doesn't have infinite flexibility. And when inflexible systems are pressured, they adjust abruptly, not smoothly. That's why paying attention now matters, before explanations are retrofitted to price. To understand where this could lead, we need to step back from the headlines and compare today's silver behavior with prior moments when markets truly exhausted themselves. Historical blow-off tops tend to share a pattern. Price surges rapidly, participation becomes euphoric, and once momentum cracks, selling overwhelms buyers because demand was never anchored to real necessity. The collapse happens fast because there is no reason for buyers to defend levels once confidence evaporates. That dynamic depends on speculation being the foundation. What we're observing now looks different. Pullbacks have been sharp, yes, but they have also been contained. Buyers continue to appear where pessimism expects air pockets. That distinction matters more than any chart overlay. This does not mean silver cannot correct. It can, and it will. No market moves in a straight line. But the nature of corrections tells you what kind of market you are in. In structurally tight environments, corrections tend to be violent, brief, and psychologically exhausting. They are designed to force weak hands out, not to signal the end of a trend. Participants who rely on emotion or online consensus usually exit at the worst possible moment, right before stability reasserts itself. That's why volatility alone should never be mistaken for fragility. So what fundamentals actually deserve attention? The first is the relationship between paper claims and physical availability. Paper markets can expand rapidly because creating claims is easy. Physical supply cannot respond at the same speed. When claims grow faster than deliverable inventory, pressure builds quietly. The system appears functional until one day it doesn't. The second signal involves immediacy. When participants are willing to pay more to secure silver now rather than later, they are revealing urgency. That urgency may not be obvious on price charts, but it shows up in spreads, premiums, and delivery terms. The third signal is inventory quality. Not total theoretical stocks, but what can realistically be mobilized against obligations. When that pool shrinks relative to commitments, the system becomes brittle. Brittle systems don't fail gracefully. Now we have to confront an uncomfortable truth. High prices eventually discourage demand. If silver becomes expensive enough, manufacturers will attempt substitution, redesign, or delay. That is real and unavoidable. But the key word is attempt. Engineering changes take time. Contracts are sticky. Production lines are optimized around specific inputs. You cannot instantly redesign the modern electrical grid or advanced electronics to remove silver without performance costs. That lag creates a window where price must do the rationing. This is why you can see stress emerge before demand meaningfully retreats. This is also why China's domestic premium matters so much. When one market consistently pays more, supply flows toward it. That reduces availability elsewhere, which feeds back into global pricing. The process is not ideological, it's mechanical. Metal moves where it is valued most. If that dynamic persists, it can create shortages in regions that assume supply would always be accessible at quoted paper prices. That assumption holds until it doesn't. Gold enters this discussion naturally. Official sector, gold accumulation has been meaningful over recent years, even though monthly figures fluctuate. Each slowdown in purchases is immediately framed as the end of the story, but incentives do not reset that quickly. High debt levels, managed currencies, and constrained fiscal space encourage reserve diversification over time. Gold maintains its role as a reserve anchor, but silver remains the wild card because it straddles industry and money. It behaves like a commodity until confidence erodes, then it behaves like a monetary asset. That transition can be abrupt because the market is smaller and less forgiving. This brings us to currencies, and it's important to keep this grounded. The dollar remains dominant for clear reasons. It is liquid, widely accepted, and deeply embedded in global settlement. But dominance does not guarantee stability and purchasing power. A currency can remain central while steadily losing what it buys. Most people do not experience currency pairs. They experience living costs. When measured against goods and services, strength often looks different than headlines suggest. From China's perspective, reducing exposure to the dollar system does not require overthrowing it. It requires building options. Alternative settlement mechanisms, diversified reserves, and assets that are not liabilities of another nation all reduce vulnerability. Metals fit naturally into that strategy. They do not replace currency systems overnight, but they complement them. This is why focusing on whether a currency will be backed misses the point. Incremental changes in behavior move markets long before declarations ever do. Now let's talk about the scenario that unsettles people the most. If China's domestic premium persists and deliverable inventories continue tightening, price discovery could begin shifting away from paper benchmarks. In calm markets, paper leads and physical follows. In stressed markets, that relationship can invert. When physical demand dictates terms, paper prices are forced to adjust abruptly. That's when gaps appear, not because of conspiracy, but because assumptions break. The assumption that quoted prices always reflect true availability is fragile. This does not mean chaos is guaranteed. Markets can remain volatile and unresolved for extended periods. Speculation can overshoot reality in both directions. That's why restraint matters. This is not a call for blind conviction. It is a call for observation. Watch premiums. Watch delivery times. Watch how weakness is treated. These signals reveal more than commentary ever will. There is also a reasonable counterargument that deserves respect. China's silver buying may be primarily industrial, not monetary. Securing feedstock, stabilizing supply chains, and protecting manufacturing continuity are rational objectives for a production-heavy economy. If that is the case, demand may be more price-sensitive than some expect. Elevated prices could slow purchases, easing premiums. That outcome would cool pressure without requiring a dramatic narrative shift. This is why committing to a single story is dangerous. Behavior matters more than explanations. Another important dimension is investor preference for physical ownership. Paper exposure is convenient. Physical ownership introduces friction. When demand shifts toward physical, mints backlog, delivery windows stretch, and spreads widen. These are not theoretical effects. They are logistical constraints surfacing. Persistent decoupling between spot prices and physical costs signals a market under strain. These conditions do not persist forever, but while they do, price behavior can surprise those anchored to old models. At this point, the practical question emerges. How should participants think about engagement? The first step is clarity about intent. Trading and positioning are not the same. Traders require defined risk limits and acceptance of frequent error. Position builders care about accumulation zones and thesis durability. Confusing the two leads to emotional decisions. Many people claim long-term conviction, then react impulsively to short-term volatility. Others claim to trade, then refuse to exit losing positions because belief replaces discipline. That mismatch is costly. This discussion also intersects with broader macro forces. Real rates and liquidity conditions matter deeply for metals. When returns on cash and bonds fail to compensate for inflation, holding traditional safe assets becomes a slow loss. In those environments, capital seeks alternatives, not out of greed but out of preservation. If policymakers respond to economic stress with easing, real rates weaken further. That backdrop tends to support hard assets, even when headlines suggest calm. Now consider energy and trade settlement. The traditional link between oil and the dollar remains influential, but it is evolving. Even modest diversification in settlement methods can alter marginal demand for dollars. These shifts do not collapse systems overnight. They change slopes. Metals often respond to slope changes rather than dramatic events. This is why watching long-term behavior matters more than reacting to daily noise. Another underappreciated factor is demand composition. Electrification, grid expansion, data infrastructure, and power electronics are not theoretical trends. They require materials with specific properties. Silver is difficult to replace entirely without trade-offs. At the same time, silver supply is largely a byproduct of other mining activities limiting flexibility. This structural constraint means supply cannot surge on command. When demand accelerates, price absorbs the imbalance. Cultural factors also play a role. In many regions, physical metal ownership is habitual, not speculative. Demand rooted in saving behavior tends to be sticky. If sentiment in those markets shifts, metal can disappear from global circulation faster than expected. Premiums again become the compass pointing toward where that pull is strongest. Fear remains the final obstacle. The fear of buying before a drop paralyzes many participants. But any strategy that cannot withstand volatility is not a strategy. Planning in advance, defining ranges, and deciding responses before emotion intervenes are essential. Markets punish indecision more than incorrect forecasts. Finally, a word on suppression narratives. Leverage and incentives exist. Volatility is sometimes managed, but not every move is manipulation, and obsessing over that idea erodes objectivity. The signals that matter most are the hardest to fake for long. Delivery stress, persistent premiums, and user behavior reveal truth eventually. The goal is not excitement. It is staying rational long enough to benefit if structural forces continue asserting themselves. Now let's bring this to a level where it connects directly to decision-making, because understanding signals without context can be just as dangerous as ignoring them. Silver does not move in isolation. It reflects pressure points across production, currency trust, and liquidity conditions. When those pressures align, the move is rarely polite. It tends to arrive when confidence is low and attention has drifted elsewhere. That is why the most significant advances in this market have historically occurred when boredom replaced excitement and disbelief replaced enthusiasm. One of the most overlooked tools in understanding silver is relative valuation rather than absolute price. Looking only at the dollar price strips away context. Ratios restore it. Comparing silver to gold, energy, or broad commodity baskets reveals when silver is under or overperforming relative to other scarce inputs. These ratios swing dramatically over time, often reflecting stress, substitution cycles, and speculative surges. They are not timing tools by themselves, but they provide perspective. Right now, what stands out is not just ratio movement, but the tug-of-war between regions willing to pay premiums and markets anchored to paper references. A question that surfaces repeatedly is whether this move is artificial. Is it simply leveraged positioning destined to unwind? The honest answer is that speculation is always present. Markets require it to function. But speculation riding on top of tight fundamentals behaves differently from speculation standing alone. When fundamentals are weak, pullbacks cascade. When fundamentals are firm, pullbacks are absorbed. That distinction is visible only after the fact, but it leaves footprints along the way. Watching how weakness is treated remains the clearest guide. Another common question centers on urgency. Does visible buying by a major economy mean everyone should rush to participate? Rushing is rarely rewarded. Markets punish haste and reward preparation. Exposure, if desired, should be built deliberately, with scaling and predefined limits. Emotional reactions to headlines tend to arrive late and exit early. Discipline outperforms excitement over time. The possibility of a formal monetary shift always captures attention. If a large economy were to credibly link its currency to a tangible asset, psychology would change quickly. Confidence is a multiplier. It alters behavior faster than policy does, but credibility requires mechanisms, transparency, and sacrifice. Without those, announcements are theater. This is why watching gradual behavior matters more than anticipating proclamations. Stockpiling, reserve diversification, and settlement experimentation signal intent long before speeches ever do. Equity exposure tied to silver introduces another layer of complexity. Mining and streaming companies can amplify moves, but they also introduce operational risk. Costs, energy prices, labor issues, political environments, and management decisions all influence outcomes. Metals rising does not guarantee equity performance. Treating these vehicles as simple leverage often ends badly. Understanding what you own matters as much as believing in the metal. Liquidity conditions remain the quiet driver behind many of these dynamics. When real yields fail to compensate for inflation, holding conventional safe assets becomes a strategic choice rather than a default. Over time, that environment encourages diversification. not all at once, but gradually. Once the shift begins, it can become self-reinforcing. Metals benefit not because they promise growth, but because they resist erosion. Preservation becomes the objective. Returning to the yuan, it helps to separate function from perception. A currency can function efficiently as a payment mechanism without serving as a trusted store of value internationally. Expanding that role requires confidence beyond domestic borders. Trade relationships, financial depth, stability, and reserve perceptions all contribute. Accumulating metals supports that perception indirectly. It signals preparedness, not proclamation. This nuance is often lost in dramatic narratives. Another factor that deserves attention is the evolving demand profile for silver. Electrification, grid modernization, data infrastructure, and energy transition initiatives are not abstract ideas. They consume materials. Silver's properties make it difficult to replace fully without performance trade-offs. Meanwhile, supply remains constrained by its byproduct nature. These structural realities mean price becomes the balancing mechanism during demand shocks. Overshoots are not anomalies. They are the market rationing access. Retail behavior also differs across regions. In many cultures, physical metal ownership is habitual, not speculative. It represents savings rather than a trade. When sentiment in those regions shifts toward accumulation, supply can disappear quietly. Premiums reflect this long before global narratives adjust. Watching those premiums provides insight into where demand is most persistent. Fear of immediate loss remains the most paralyzing emotion. The question of what happens if price drops after entry stops many from acting. But any plan that collapses under volatility was never robust. Thinking in tranches, defining responses in advance, and separating analysis from emotion are essential. Decisions made during stress are rarely optimal. It is also necessary to address the obsession with suppression. Leverage exists, incentives exist, volatility can be influenced. But attributing every move to manipulation erodes analytical clarity. Not every decline is engineered, and not every rally is liberation. The signals that matter most involve logistics, delivery, and sustained behavior. Those are harder to fabricate over time because they involve physical constraints. The objective of this discussion is not to encourage blind conviction. It is to encourage attentiveness. Structural shifts do not announce themselves loudly. They reveal themselves through inconsistencies, premiums, and persistence. Ignoring those signs because they do not fit comfortable narratives is costly. As we approach the end of this analysis, the core message becomes clear. Silver is responding to a convergence of forces. Industrial reliance, constrained supply, shifting trade dynamics, and evolving currency strategies are interacting in ways that make old assumptions unreliable. China's domestic premium is not a guarantee of any single outcome. It is evidence of tension. Tension eventually resolves, often abruptly. The most powerful moves in this market rarely occur when enthusiasm peaks. They occur when patience thins. When participants conclude nothing is happening, volatility fades, and attention shifts elsewhere. That is often when structural pressure asserts itself. Watching delivery signals, regional premiums, and the character of pullbacks offers more guidance than any prediction ever could. This is not about certainty. It is about probability and preparedness. Markets do not reward those who demand guarantees. They reward those who recognize when conditions have changed and adjust accordingly. Silver's recent behavior suggests that something beneath the surface is evolving. Whether that evolution unfolds smoothly or violently remains uncertain. What is clear is that dismissing it outright carries risk. In closing, remember that education precedes action. Understanding the system you are navigating matters more than reacting to noise. Silver sits at the intersection of industry, money, and trust. When trust wavers, that intersection becomes volatile. Observing calmly, planning deliberately, and refusing to outsource decisions to loud voices are the most reliable advantages available. Everything discussed here is for educational and analytical purposes only. Markets involve risk, uncertainty, and personal circumstances that vary widely. No single framework fits everyone. The responsibility for decisions rests with the individual. The goal is not prediction, but clarity.